As crypto begins to gain traction in the mainstream media, albeit slowly, people have heard of mining or are beginning to hear of mining. But what does it really mean and how do you go about doing it? Let's dissect this. Picture gold underneath the ground. Its value is hidden until we dig it up. That is the mental visualization of mining you've got to have in your head. That is essentially what happens when you mine Bitcoin, except you don't physically unearth anything. In Bitcoin mining, miners do so by exerting computing energy to complete or verify transactions of blocks. If you don't understand the basics of Bitcoin, go and look at my video. It will be somewhere up here, up there, down there, down there. These blocks, they're added to the blockchain post verification. And when a single miner completes a block, they're rewarded with a Bitcoin or Bitcoins. I think it's a Bitcoin. Mining for Bitcoin isn't as cheap as it once was, but that doesn't stop people from doing it. The block reward of Bitcoin is what incentivizes miners to continue to mine Bitcoin. And when you think about it at the start, it was very easy, but now it's slightly more difficult, but the price is higher. Because this responsibility is carried out by people all over the world, in China, in the US, in the UK, everywhere, Bitcoin is given the name of a decentralized currency. Mining is in effect to prevent individuals from the problem of double spending. Double spending in cryptocurrency is where someone tries to spend the same coin twice. In physical currency or fiat money like coins and stuff, it is trying to go down to the pub to buy a drink with a £10 note and then pop to the shops to buy some groceries with the same £10 note. With cryptocurrency, there's a risk that someone can make a copy of that coin and then spend it, which would mean that all trust is lost if everyone was to do that. In the real world, the cashier would look at the £20 note or the £10 note and they'd verify that it was real. Bitcoin uses a consensus mechanism called proof of work. The process of mining Bitcoin works as follows. A miner's computer, called a node, collects and packages individual Bitcoin transactions from the last 10 minutes into a block. This node competes with other nodes in the network to solve a complicated cryptographic problem to be the first to validate the new block for the blockchain. The first miner to solve the problem broadcasts their success to the entire network. The other nodes then check if their solution is correct. If correct, the new block is added to the blockchain and the whole process starts again. As the first miner was the first to solve the problem, it gets rewarded, he or she, it gets rewarded with a Bitcoin. But before we go on, let me lay out some foundations with some definitions. A block, files where data relating to the Bitcoin network are permanently recorded. A block header, portion of the block that contains information about the block itself. Hash, a function that converts an input of letters and numbers into an encrypted output of a fixed length. Number only used once. It's a number that the blockchain miners are solving for. In order to receive cryptocurrency in Bitcoin, the nonce is a whole number somewhere between 0 and 4,249,967,296. Hash rate, measure of how many times the network can attempt to complete this puzzle every second. So you're gonna have to bear with me, and if you aren't really feeling technical, I would probably just skip till the end of the video. Using those definitions, I'm going to try and explain the ins and outs of what actually happens when you mine Bitcoin. The block header, that chunk of data, is then put through a SHA-256 hash function. If the resulting number is higher than the target hash, the miner adjusts the number only used once and tries again. Miners do this many times over in seconds, and that's the exertion of the computing power. When a lucky miner, I say lucky, it's pretty much luck, hash function spits out a result that's lower than the current hash rate, you've got a winner. The block is broadcast to the entire network, and each node, each computer, block header, hashes to meet the target. And if confirmed, the newly mined block is added to the blockchain and the miner receives a Bitcoin. So in sterling, it's around 30,000-ish, maybe more, 39,000. And in dollars, right today, it's around 55,000-ish. These rewards serve to incentivize participation in keeping things running smoothly. The rate at which coins are issued is built into the mining code, ensuring that the time it takes for the miner to win a block is always approximately 10 minutes. This is to protect the system so that the miners don't go and just start creating their own Bitcoins. Every time a Bitcoin is mined, the cryptographic problem gets harder to solve. That's where crypto comes from. And if you don't quite understand where the ins and outs of crypto, go and watch the other video. As I said, they become harder to solve. So the hash rate gets higher. And as a result, the miners have to exert even more computing power, and to earn a block becomes more difficult. So what I'm saying is that even more computing power is needed to mine the same amount of cryptocurrency. So the computer power needed to mine a Bitcoin when it was first mined in 2008 ish, maybe I think it was 2009, is considerably less than what it takes to mine a whole Bitcoin today. Solving the cryptographic problems are necessary for protecting the Bitcoin network. To reverse transactions in the network, it would take 51% of the whole network's computing power to reverse the transaction. So in essence, you would need more computers than everyone else in the network, than half of the people in the network, to reverse a transaction and game the system. As Bitcoin mining has matured, the barrier for entry, as I said, to Bitcoin mining has got higher. You can still mine on your personal computer, but to mine a whole Bitcoin in '09 would have taken a couple of hours, maybe a couple of days. Now it would take the equivalent of, if I was to do it off my Mac, around 98 years. And by that point, all the Bitcoins would have been mined anyway, so there's no real point in mining. There are other currencies that you can mine, but we'll do another video on that. Miners are heavily influenced by CPU power, or GPU power in this case, also by electricity costs. So you'll find that miners relocate or set up deals with electricity providers or relocate to places in the world that have low electricity costs or are near cheap electricity. Nowadays, most of the miners, I'm not sure if you can call it that, but they are used by pools of individuals. So these are where miners get together and they mine collectively under the same banner, and they share the reward of the Bitcoin that is earned. However, some cryptocurrencies are now moving away from what Bitcoin's consensus mechanism is, which is a proof of work to a proof of stake. And again, there'll be another video coming on that. But Bitcoin, however, is staying with the tried and tested proof of work algorithm. And that is Bitcoin mining in a nutshell. I hope you understood the video. Stay striving, my cryptologists. Don't forget to hodl.